The Fed raises rates to slow inflation. The Fed also lowers rates to stimulate the economy. But what happens when we simultaneously get inflation and a slowing economy? Well, you get a recession. And it is a policy error that the Fed has cornered itself into, and it has resulted in three major events that have made recession inevitable. As we know, inflation is running at 40-year highs. The CPI reading for June was 9.1%. So the Fed needs to raise rates. Although the Fed denied planning on raising the interest rates by a full percentage, we can still probably count on another 75 basis point hike, which will bring the Fed funds rate to 2.4%. This is the same level of Fed funds rate that caused stocks and bonds to crash in 2018. And then there's the GDP. US GDP for the first quarter was a negative 1.6%. Second quarter GDP, according to the Atlanta Fed tracker, looks to be coming in at negative 1.6%. A recession happens when there are two consecutive quarters in a row of a negative GDP. And we are almost there. The U.S. Purchasing Managers Index, the PMI for services, was released last week, and the number is at 47. Anything lower than 50 is a clear sign of contraction. What's the bottom line? Well, friction between rising inflation and a contracting economy will most likely put us all in the middle of one, and we will end up with one of the worst recessions in modern history. A hard landing is imminent, and it is time to look into your portfolio and make sure that it is recession-proof. You might need to reallocate if needed. Most importantly, you should always consult a financial advisor. My name is Anna Kate with Noble Gold Investments.